Hello and welcome back to the channel, your go-to source for demystifying the markets and uncovering intriguing stock setups. Today, we're diving deep into a specific microcap that's recently landed on our radar due to an unusually high cost to borrow. We're talking about NCT. Before we get started, please remember, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's zero in on NCT. This is a micro-cap company, and details regarding its specific sector are not readily available, which often means it's a smaller, less followed entity. Despite its relatively unknown status, NCT has appeared on our hard-to-borrow screener, signaling a potential situation that warrants closer examination for those interested in the mechanics of short squeezes. Now, regarding its recent price action and volume, it's quite unique. NCT has seen a plus 0.0% change today, over the last 5 days, and even over the last 30 days. Similarly, today's volume stands at 0 shares, with a 30-day average volume also at 0 shares, meaning its relative volume is 0x average. This lack of trading activity is a crucial detail we'll discuss. What is cost to borrow and why it matters? For beginners, let's quickly break down what cost to borrow means. When someone wants to short sell a stock, they first need to borrow shares from someone who owns them. The broker facilitates this. The cost to borrow, or CTB, is the annualized fee that the short seller pays to the lender for the privilege of holding those borrowed shares. Show animation, lender-broker short seller market. Why does it matter? High CTB indicates that there's strong demand to short the stock, but limited supply of shares available to borrow. When CTB fees exceed 100%, as they can, it means short sellers are paying over 1% of the stock's value every few days to maintain their position. This is a powerful signal of scarcity and conviction on both sides, those wanting to short and those holding shares. Why this stock is hard to borrow right now. Now, for NCT, the numbers are striking. Our data shows an annualized cost to borrow fee of 677.5%. Let that sink in, nearly 7 times the stock's value per year just to hold a short position. Highlight CTB, 677.5%. This extreme figure suggests that shares of NCT are incredibly difficult and expensive to borrow. While the exact number of shares currently available to borrow is unknown, we do know its estimated float is remarkably small, at just 0.3 million shares. Highlight float, 0.3 M shares. When a float is this tiny, even a small amount of short interest could significantly impact the borrower supply, driving up those fees. The zero volume data suggests extreme liquidity, which can make borrowing shares virtually impossible, further inflating the CTB. Squeeze mechanics explain. So, how does a hard-to-borrow situation relate to a short squeeze? A short squeeze occurs when the price of a stock rises sharply, forcing short sellers to buy back their borrowed shares to limit their losses. This buying activity further pushes the price up, creating a snowball effect. Chart, price rising, short sellers covering for NCT. If any buying pressure were to emerge, even on minimal volume given its current zero volume, the combination of a tiny float and exorbitant borrow fees could theoretically put extreme pressure on any existing short positions. Short sellers would face mounting daily costs and rapidly increasing unrealized losses, potentially forcing them to cover, which in turn could ignite a price spike. Our internal composite squeeze score for NCT currently stands at 42.5 out of 100, which reflects this combination of high CTB and small float, but it's not yet in the higher tiers, partly due to the lack of volume and price momentum. Dilution risk check. One critical factor to consider in any potential squeeze play is dilution risk. Dilution happens where a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can completely offset or negate a short squeeze thesis, even if the cost to borrow is sky high. More shares mean more supply for short sellers to potentially borrow or buy, easing the pressure. In the case of NCT, our checks found no recent dilutive SEC filings, such as S-1, S-3, or 424B, in the last 90 days. This is a positive sign for any potential squeeze scenario, as it removes one significant headwind. Let's pause here for a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. while NCT 677.5% CTB and 0.3 million share float make it an intriguing candidate for a hard-to-borrow study. It's crucial to be balanced. A high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. The critical missing piece for NCT right now is volume and price action. With zero volume over the last month, there's simply no liquidity or current trading interest. Should blank volume be enough for any squeeze potential to materialize, you would need to see a significant and sustained increase in trading volume along with upward price momentum. Without that, the high CTB, while extreme, is just a reflection of extreme liquidity rather than active short pressure. Always consider the full picture. NCT presents an interesting case study in the world of hard-to-borrow stocks, primarily due to its astonishing 677.5% cost to borrow and tiny 0.3 million share float. While the lack of recent dilution is a plus, the complete absence of trading volume means any short squeeze potential remains purely theoretical for now. It's a prime example of how extreme liquidity can create extreme borrow fees. Keep a close watch on volume indicators should this stock ever awaken. If you found this analysis insightful, please hit that like button, subscribe for more deep dives into unique market situations, and let us know in the comments if there are other hard-to-borrow stocks you'd like us to explore. Thanks for watching, and happy learning!